Morning, everybody, and welcome to the Ankerstar Wealth Morning Show. We have three exciting topics for you today. Now that we're both back in our home offices that you may recognize, we're going to talk first of all about the thing that should be on the top of your mind if you haven't taken care of it yet, is your IRA contributions for 2023. Last year, right? So it's set up so you have all year to make your money, make your millions, that sort of thing. And then you get the first up until the tax filing day to figure out your situation and fund those. And then you can also fund your 2024 ones. So we'll talk about the rules associated with that. Secondly, if you happen to have a large capital gain from selling a property, selling a business, or if you're with Ankerstar Wealth, it's selling Bitcoin. Because remember, we first moved in, some of us was early as June, some of us as late as November. We had that large gain in MicroStrategy, and then we sold that to move over to GBTC briefly until the ETF showed up, and then we went to BITB. Anyhow, blah, blah, blah. If it was in an IRA, hey, no tax consequences, right? Whether it's traditional or Roth, worry about it, later. With your taxable account, though, you have the issue of whether you owe taxes on that or not. If it's over, I'd say 50,000 of a gain, good problem to have, but it did double in that time frame. So if you have that, you can put it into opportunity zone. We'll talk about the special tax consequences there. And then Mike will conclude talking about automotive stocks. Now, we have talked about like car makers and stuff, but he's going to talk about the automotive stocks, whether we're in them or we're not, and whether we should be or not. But that'll be good to hear because, hey, we grew up all thinking about cars, right? So looking forward to hear what Mike has to say there. But before we get started, this is a financial education presentation. So you have to do your own due diligence for acting upon anything you hear in this presentation. More disclaimer information is available at ankerstarwealth.com. Let's go ahead and get started with everybody's favorite topic, which is IRAs. There we go. Should be coming to you now. Okay. A lot to talk about, and we're not going to talk about everything, but as far as whether it's Roth or traditional, you have a certain amount that you can put away each year to your IRA. You have the whole calendar year to do it, and then you have up until filing day for the following year to be able to make it right for the previous year. Once you exceed that time, then you can't go back and fill it back in. Same thing with 401ks. You have to do it now. You can't make it up later. So you do want to take advantage of it if you have the cash flow to be able to do so. Roth or traditional depends on your situation, not the topic of the day. However, what is the topic of the day is what your income is. So when you go to actually put money into these things, you do it correctly. This is where you're probably going to need to engage your advisor if you're getting close to the income limits. And let's scroll down and find them here. Roth income limits. There we go. This is 2023, so we're talking last year. It is your MAGI, so you have to know a little bit of what goes into that calculation there. TurboTax will do it for you. So will H&R Block or your CPA. If you're using some other system, that's good for you. Figuring out what your MAGI is. But yeah, it goes up to less than 218. Then there's a phase out period because why draw just a hard and fast line and make it easy on everybody in the industry? Let's have what is this, $9,000, $10,000 phase out where, math. And then 228 or more, and you can't do it again. These are, this is assuming married filing jointly, which is the example that I'll use there. So again, if you are around these limits, you need to go slow to make sure that you put it in the correct account. If you are above the Roth limit where you can't do a Roth directly, so we're down in here, this 228,000 above, then you can do a backdoor Roth IRA, which again is a whole nother topic on how to do that. But you want to go slow, read the rules, and or engage with your advisor here at Ankerstar Wealth to make sure that we're doing that. We're scrubbing the accounts now. We did it initially in January, and now we're back at it since we have 30 days. Jaden's got the point on this to make sure that everybody's doing the right thing. If you accidentally put it in the wrong account, guess what? Like with anything else, call us, let us know that you did it. We might be able to turn off the, if you just did it, we'll be able to call Schwab and get it undone for you. That's easy. If you do it and then figure it out 3 days later after the money moves, we can still help you We just got to do a little paperwork to get it undone. So sometimes I like to keep a big smile on my face during tax season. March 15th to April 15th, it's sometimes a challenge to keep that smile going, because this is all just you know, a little mini fun fest, if you will, of making sure everybody gets it straight. But it's important you get this straight to take care of yourself and your family for your future. So if you have any questions, reach out to your advisor or me directly. All right, second topic that we're going to talk about is an opportunity zone. What is it, you say? Most people haven't heard of it. When these came out, it came out of the Tax Cuts and Job Act. You know, Trump brought this in 2016, 2017 timeframe. I didn't really use it until 2020 or so I wasn't quite as familiar. We do have an expert. We use a fund with Cantor Fitzgerald, who has an assigned expert to each one of us as an advisor to help us walk through this, because it's a little confusing. But the big picture is there are places around the United States that could use some money to be improved and developed. These are called opportunity zones. So they're identified and they're officially sanctioned by the government. And when you invest in these, you get a tax break for doing so. So it's worked fantastic. There's rules in place depending on how the election goes. I think we will see more of this if the election turns, goes to Trump, of this developmental type stuff and the tax breaks that go with it. So if you have a capital gain, so let's break for just a second. So you have $100,000 and you invested it in either real estate or a stock, and then it went up 50% and you sold it. So you, as of the date of the sale, you have a $50,000 capital gain. Okay, you can take that $50,000 if you have it. I mean, you may use it for something else, but if you want to, you can take that $50,000 and instead of paying taxes on that $50,000 now of that gain, you can invest it in an opportunity zone. And there are a whole new set of rules goes with that. But the good news is you don't owe any taxes on it now. So I will use Bitcoin, for example, for somebody's taxable account that we put 100K in and it doubled in a few months, and then we sold it. It's a short-term capital gain, less than a year. All of that is going into the opportunity zone instead of paying their tax rate. Short-term capital gains are taxed at your income rate, which is the worst one. Goes right into opportunity zone, and now that money's locked up for either 5 to 10 years. There's this paragraph I have pulled up. I don't expect you to read it, but if this is something that interests you, you don't pay the taxes now. You pay the tax, you defer them. You pay taxes on that 50 or 50,000 or 100,000 or whatever it is you put in there later. But that's exactly when the fund is designed to start kicking off a distribution, and it kicks off distributions about what you owe in taxes. So you defer initially, then there's a tax break for the money while it's in there, either 5 or 10 years, and then anything held after that is tax free. So the Cantor folks say it's like a Roth IRA on steroids. I'm starting to see that now. It's a lot of math, so if you don't like math, you won't like the opportunity zone. But and it's for your CPA to figure out. But big picture is you can save a lot on taxes. This is something to where if you sold a business and you had $3 million, you don't want to take the when you made $3 million, you don't want to take all that and put it in an opportunity zone because it's locked up and now you're rich but cash broke, can't feed the family, sort of thing. But if you have say a $3 million gain, you can put 500,000 of it into the opportunity zone or some other allocation, so you can still have cash flow to get through life, but you have this money that's growing tax free eventually. So that's all I'm going to say for that. A little bit confusing. Do some self-study and then reach out to your advisor if you have that. They think it applies to you. I will say there is one big number you need to know about: 180 days from the sale date, and this window closes. So, i.e., I transitioned most of the book from MicroStrategy to GBTC on December 27th. So that would be the time frame. And again, you don't want to call me on day 179 and say, hey, Steve, tell me more about the opportunity zone, right? I might not be able to pull that miracle out of my hat that day. So give us a little bit of time to work through this for you. Okay, that's all I have. Let's turn it over to Mike to hear his always entertaining presentation talking about, he came from the auto industry way back in the day. So I'm anxious to hear what you have to say, Mike. Over to you.
Yes, before I share my screen, I just want to say that, we deal with investment themes. So a lot of times it's like, where's the population investing in, what are they using, what services, and then do we want to be a business owner of those services? So I'm going to start off and show you what we see a lot of the business, or a lot of the youth investing in, or at least using, is DoorDash, which I've covered before. So what is DoorDash? It's one of our ego stocks, exponential growth opportunity, trading at a 52-week high today, which is great news. But what is DoorDash essentially? It is essentially a marketplace that connects restaurants, fast food restaurants, with people with cell phones, connects them together to make an exchange of services, usually overpriced, a little bit more expensive than you'd pay if you just went there. And when I think about that, I think, what was I like when I was a teenager? What did I want to do? I wanted to get in a car so that I could drive to a fast food restaurant. Well, DoorDash has eliminated the need for those teens to need a car. It's changed that car industry. So, one thing I want to point out about this, and which I think is very interesting, is this company is worth $53 billion. So whether you think it truly is worth 53 billion or not, that's what the market says it is worth, 53 billion. And that's important to remember, because I'm going to come back to that. So another thing that we always remember as in investing, you'll always have someone say, wow, if I just wouldn't have bought that and I'd bought the stock instead, I'd be a billionaire, or a millionaire or whatever. So when I think of automotive, and I'm going to go back to 50 years ago, and I'm going to share this picture. 50 years ago, this is a 1974 Corvette. And you say, wow, if instead of buying this 1974 Corvette, I would have just taken my money and I would have invested it into GM stock, I would be worth $0, because GM went bankrupt in 2008. So you should have just bought the Corvette, right? I get it. Maybe you would have sold your GM stock at some point, but it's kind of that analysis, like, oh, well, automotives have changed. Now, what I'm going to do is, GM did emerge from bankruptcy, but of course, all their stockholders were wiped out. So I am going to show actually GM stock here. So the first thing I want to point out on GM stock is, this is a 5-year graph. And here, I can shrink it down. So you're going to see about 5 years of this graph. And it only goes back to like 2010, 2009, when it emerged from bankruptcy. So one thing is important to note. It is a $46 billion company. So this company is worth less by the market, less than DoorDash. And for me, it's a little troubling. Like, would I rather own a company that, we make this app and it connects people to buy fast food and have things delivered, or would I rather own the manufacturing capacity assembly for Corvettes and Chevy Blazers and Suburbans? And it's hard to conceive, because it seems to me like the automotive company would be worth more, but it's not. And you can see over 5 years, that line is relatively flat. We can see the dip in 2020 and then the reemergence. But if you'd have bought it 5 years ago, you'd be about exactly where you started at. So I thought, let's compare that, because maybe you're not a GM person. I did work at GM Delphi many years in the 90s. I wasn't in the heyday when it was the #1 biggest company in 1974. But let's compare it to, let's say that you are a Honda person. So let me bring up Honda on the comparison graph here. We're going to put in Honda. Would you have done much better? No. Honda is the little green line. You'd have made 30% instead of 11. So, but maybe, and I have a wife who works for Ford. Maybe you're a Ford person. Ford doing any better? Not really. Let's go another one. So maybe you're Chrysler and you're like, this is Chrysler. No, it's not actually called Chrysler anymore. It was purchased. It's Stellantis, and Stellantis has done better. So it's actually up more, purchased by Fiat, and several mergers have happened. So what's a modern company? You're like, oh, I need something. I'm much more aggressive. What if I had bought Rivian, right? And we're going to go to Rivian here. Rivian is down 77%. So good thing you didn't buy Rivian. Now, when it comes to the automotive stocks, we do not have any pure automotive plays in our models. We do get some exposure through, say, an S&P 500 or a equal weighted index. We do get a little exposure, but that's a good thing because we, looking at these returns, maybe even 170% over 5 years, you think is a good return, and maybe that one is, but most of the automotive stocks have not done well. But of course, the one automotive stock that you want to bring up and you want to say, but wait, there's one more. He didn't put it on there because it probably looks quite different. So I'll go ahead and put it in here, and it's Tesla.
Yeah.
And Tesla has even dropped, I looked, 60% from their high. So it's down 60% from only a few years ago. But Tesla's that yellow line that you can see it blew up in 2020 and has taken off. So there are places that you might want to be. But I just want to say overall, we do things based on themes or thesis. We want to think about where the consumer's going. When we look at auto insurance and the prices of that, today's youth, I hate to say it, my kids, it's not the first thing they wanted to do. They want to say, oh, they don't say, I want to buy a car. What's the first thing they really want that's expensive? Maybe when they're 13, 14 years old, they want a phone. They want a phone. And what's the number one or number two highest value company? Apple. So, so basically the market reflects what consumers buy. And that's why we are theme based and not, all of General Motors Corvettes we could own or Mustangs from Ford. We go where the market goes. So that's what I've got. We'll turn it back over to you, Steve.
All right. Very insightful stuff, Mike. And, I hope you enjoy the fact that we have Mike on the show now. So please leave comments if you like what you see, or if you want to hear more analysis on your pet theme, certainly kick it over to Mike. He's our Chief Investment Officer. He loves digging into this stuff, and obviously he does a fantastic job with it. We did talk a lot of individual names there, so just a reminder on that disclosure, you have to do your own due diligence for acting upon anything that you hear in the show. And with that, hope you guys have a fantastic weekend, and we will see you guys back tomorrow. Bye.